This episode, we're going to be discussing business acquisition loans using the Small Business Administration's 7A loan program. And we're thrilled to have Jessica Beck, Vice President, SBA Lending with Wells Fargo, join us for about a 20-25 minute discussion. And we're going to walk through SBA lending, some of the nuances around a business acquisition loan, and then talk to her about what she sees as far as interest rates and their program offerings. So if you're in the market for a small business acquisition loan or just want to know more about SBA, stick around. This episode's for you. Now, we've dedicated this channel to the concept that the more you know, the better decisions that you'll make. So join me as I discuss buying, financing, growing, and selling privately held businesses. If you're a business owner, a first-time business buyer, or a trusted advisor, you've come to the right place. So if you enjoy this episode, hit like and subscribe, and let's get started. All right, so I want to welcome Jessica Beck, who is Vice President of SBA with Wells Fargo Bank, to the channel. So, Jessica, thank you for taking the time on a Friday afternoon, St. Paddy's Day, by the way. So neither one of us are wearing green, but that's okay. So I invited Jessica. I've had the opportunity to do a couple of transactions with Jessica, and I will tell you what I really appreciate about her is transparency, communication, follow-up, and the ability to not only resolve problems when they come up, because in a transaction, especially in a business acquisition, there's always going to be a bump along in the road somewhere, and having a partner in a lender that understands that and helps you through those bumps is really important. So I thought I would we asked Jessica to join today to just kind of talk about the 7A program, kind of just the standard, give a quick description, but then really talk about some of the nuances, anything that might be coming down the pike. And I know Jessica's real busy, and I think that's one of the reasons is that they offer a fixed rate term, which a lot of lenders in today's market with escalating interest rates don't. So with that, Jessica, you want to just kind of give us an overview of the program, and then we can kind of go into some question and answers.
Yeah, of course. Thanks for having me. So yeah, SBA stands for Small Business Administration. And the way it works is it's still the bank's money, but it's government backed. And so with that government guarantee, it allows us to lend to businesses just like we were describing on a business acquisition where we're fully unsecured. Because we have that government guarantee, we're able to lend longer terms and a lower down payment. So it helps a lot more borrowers qualify for financing.
Yeah, so I know that SBA terms range from anywhere from 3 to 10, and most of the transactions that I've done are a 10-year term. Are you seeing the same thing?
Correct. I've never done a term at 3 years. It's usually 7 or longer is typically the length I've seen. I guess if the equipment's useful life is shorter than 7 years, I guess that would be a reason that we would look at a shorter term, but it's usually 7 or 10 years. And on a business purchase, we'd look at 10 years.
What is your typical structure that you're seeing today? I mean, 10% down, 15% carry, or vice versa, or are you still seeing seller carries in all the transactions that you're doing?
Yeah, so right now the SBA is requiring 10% down from the borrower. And the way Wells Fargo structures it is usually we want to see 15%. And that can be a combination of a seller carry with seller carrying 5% and then the borrower coming in with 10% is typically how I'm structuring it. Although with these higher interest rates, we are having to go back to the sellers a little bit more than we'd like and ask them to carry a little bit more to help us with debt service coverage requirements. So that's often what we're seeing.
Kind of interest rates that the sellers are getting in today's market on their portion of the note?
Yeah, it's significantly higher than even last year. I mean, you can probably speak to this too, Brent, but they're
Yeah.
probably seeing 6, 7, 8%. I saw
Yep.
one at 9 on the occasion. So that's kind of the nice part.
So in the seller carry or in a structure of a transaction, there are two things I wanted to talk about. And one was an earnout, which is not allowed through SBA. And the other one is a clawback, which is typically put on the seller note where if something doesn't perform in the business, whether it's customer transition or profitability or some level of measurable, that part of the note can be clawed back or held back and reduced as part of that penalty. So talk a little bit about why an earnout's not allowed and maybe what you're seeing. Are you seeing a lot of in today's interest rate and risk environment, any or clawbacks coming across your desk?
Yeah, like you said, earnouts are not eligible for SBA because they really want to set price. They want to know exactly what the seller's earning, and they don't like an earnout. So if someone's doing that as a transaction, I'm typically not involved. Then it's all seller carry financing.
Yeah.
And then with the clawbacks, yeah, I see those often in seller carries, and in fact, even though we looking at 5%, sometimes buyers will request higher for that very reason. So then it keeps the seller on the hook a little longer to ensure a smooth transition.
So let's talk about the term on a seller note. Traditionally, in the past, it's usually matched the term of the SBA loan, but that's not an absolute requirement, right?
Yeah, honestly, it truly depends on the strength of the buyer and then also the strength of the business. Because, I mean, some businesses can support a 5-year payout on the seller note and others cannot. So it just really depends.
Yeah. So we're always offer our clients when they're trying to negotiate a transaction that anytime you see like a seller note where there's will be paid, amortized over 10, but paid off in 5, our advice is really to put an interest rate escalator in there because who knows if you can get that note refinanced and then you're in a world of hurt.
Right, exactly. I mean, you can certainly look at refinancing it after 2 years of timely payments, but you're right, it's not guaranteed.
Yeah. So, and it's usually 2 years and then there's time to put the package together. So it could be 3 years before it actually gets done, right? So talk a little bit about the advantage of purchasing real estate if you have the opportunity at buying a business. The obvious one is really the terms.
So you get 25 years on the real estate portion and then 10 years on the goodwill portion on the business side. So usually you're looking at depending on how much you're paying for the business versus the building. If all things are equal, I mean, you're easily looking at a 15 to 18-year term. So it helps stretch out your monthly payments if you're able to buy them together.
Yeah, that's right. Yeah.
And then the other nice part, too, is you lock in your rent payment as well.
Yeah. Talk to me a little bit about interest rates because they've been going up, down, and then back up again.
Yeah. I mean, obviously, interest rates keep, being unpredictable, as you like to say. But yeah, we do lock in the rate at loan approval. Like you mentioned in the beginning, Wells Fargo is very competitive in that market that we offer rates fixed for the life of the loan. We can also fix it for 5 years and then look at an adjustable. But recently it's been kind of an inverted yield curve where the shorter locked rates are higher than the rates locked for a longer period of time. So it's a very bizarre rate environment that we're in.
Yeah, and it looks like it's going to continue for a while. So as of today, just a general quote on your fixed rate 10-year term.
Yeah, don't hold me to this in this video if you're watching it a year later.
No, we won't.
As of St. Patty's Day in 2023, I mean, we're looking in the high 7% range.
Okay, that's a lot better than some of the adjustable quotes I've been getting because of what you just said, tied to that short-term yield curve or an inverted yield curve. I get people who call me all the time looking for businesses, and they say, well, I'm pre-qualified. And I'm like, okay, well, there's two parts to being pre-qualified. So, and I know you and I talked about this last week or the week before. So can a buyer truly get pre-qualified to buy a business?
I mean, at a very high level, I mean, I guess yes, because I can look to see, do you have cash for down payment? Are you living within your means? Because we do look at that. But yeah, it is kind of challenging to be like, absolutely, you can buy any business out there, because obviously it needs to translate to your industry experience, because we usually like to have some sort of transferable industry experience. And then obviously certain industries you do need to be licensed and have direct industry experience. Like an adult care home would be a prime example. You obviously can't just suddenly get off the streets and know exactly how to run that industry and get a license for that.
Yeah. So, and I know we've done a lot of construction companies, whether they're trade companies, HVAC, roofing, plumbing, electrical, and obviously there are people that are buying them are from the trades, but they may not carry the correct licenses. So part of what we always, tell them is before the closing, you're going to have to obtain those licenses, because they don't go with the business, they go with the individual.
Right, exactly. And also we don't want an employee to carry it, because if that employee quits and they're not tied to the loan, I mean, then you can't run your business. So we really want the business owner to have that license.
Yeah. So talk a little bit about the debt coverage ratio. So this is something that when Bill and I, my business partner, are putting a transaction together, we always put that 90% of the time into the offering memorandum, so that, because most buyers have never seen that before, right? So they just really don't understand it. And we've got a kind of a 2-paragraph descriptor of how we've come through that debt coverage ratio. But so debt coverage ratio is really the cash flow. And then from that, you take the owner's compensation, what they're going to need. And this is where we really advise our buyers to be very honest about their monthly bills and how much it's going to take to continue to live on a monthly basis. And then so that owner's compensation, and then the debt service from both the SBA and or the seller note combined, and how many times that goes into, you get a cash flow that's left, and then there's a division. So usually 1.4 to 1.5 is a ratio that everybody's looking for. The question is going through and establishing that cash flow to use as the, a lot of banks won't use some of the things that brokers put in traditionally into that cash flow. So when you're looking at a debt service, or your underwriters are, how are they calculating the cash flow of a business?
Yeah, that's a great point, Brent. Yeah, I get some listings that have all sorts of add backs, and we really don't like that. I mean, the add backs that we'll add back is the traditional, so the depreciation, the interest, the amortization. If they're buying the building, then we would add back the rent as part of that, because that's kind of arbitrary of what they're charging rent.
Right.
And that's kind of what we include in the cash flow of the company to calculate that debt service coverage. We'd have to have a really good reason to add back other add backs. We'd have to have a really good story to get comfortable.
So traditionally what you'll see is auto allowance, travel, entertainment. And most times if that's the difference between you, on the cash flow and the debt service coverage, it's probably too tight to begin with. As a buyer, you want some room to be able to do that. So SBA has an insurance guarantee. So do you usually roll that into the loan amount? Is that financed, or is that paid in cash at closing?
Yeah, so we have the SBA fee financed within the loan.
Okay.
And right now is a good time to borrow, especially if you are a smaller borrower, and smaller is under $1 million, because right now the fee it's free for loans under $500,000, and then they're only charging up to 1% to $1 million. So it's extremely low on those loan amounts, but then after $1 million, it's very high.
Yeah, it
It's
goes up.
business as usual.
Yeah, no, I get it. So they're encouraging smaller business transactions right now.
Correct.
Is this temporary? When did this come into effect?
This went in effect with the October 1st SBA fiscal. So we're tied to the government. So come September 30th, 2023, these fees could be completely different.
Okay, good. Well, there's another advantage to taking advantage to doing that right now. Personal guarantees. So this is something I always tell everybody up front on the buyers is you're going to have to personally guarantee the loan, including putting up probably your house as collateral. So talk about that and the goodwill, or what we call in the industry the airball.
Yeah, I mean, because we're essentially lending on your resume and the business performance. So we just want to make sure you're 110% behind what we're lending on. So yeah, the SBA does require personal guarantees. And they do require, if you have additional collateral, that it's pledged to demonstrate goodwill, that you're going to stick with the business. But of course, we never want to act on that. I always tell customers, so we portfolio all of our loans, so we don't sell them on the secondary market. So if you're having issues, it's always best to call us and tell us you have a problem so we can help you through that.
Right.
Because we never want to act on any of that.
Right. If you're getting let's say you buy a business for $1 million, they've got probably $250,000 in equipment and that you can actually attach. That leaves $750,000 down, and left in that equation, and you're only borrowing say $750,000. So there's literally $500,000. A lot of institutions will try and collateralize. So if you've got a house and there's $500,000 equity, but you have a second home as well, traditionally, would you try and secure both or just the primary residence?
It'd be enough that the SBA requires that we either keep going till we're fully secure, or we've taken everything that's available.
Okay.
Does that make sense? So like if we're unsecured by $1 million and the borrower has 1.5 million, we can do limited liens to keep it at the exact amount of the $1 million. Or if we're doing a $2 million transaction and the customer only has $1 million in collateral, we're still doing that loan. It's just we're unsecured by a portion.
Right.
And they've pledged what they have.
Yeah, that's good. Well, and I think that's great advice for borrowers if they get in trouble, to call early and quick. You'll get a lot more cooperation, especially if you've been in the business 2 or 3 years and you've been making payments. There's a lot more forgiveness and a lot more flexibility to work things out, whether you may need a deferral for a couple months or whatever. But don't hit the lender. Here's a tip. Don't hit the lender when you don't have anywhere else to go. Talk to them first, and because they are your business partner as you move through time and space. So working capital, lines of credit. So not all businesses really need a working capital line of credit, but there are 2 ways to do it. One is to do a separate line of credit facility so that you've got it, and that's usually outside of SBA with the bank, and the others to include it as funded up front. You're borrowing it, but you're funding the entire amount of the working capital up front. You guys do both, or how are you doing that?
Yeah, we'll look at both, but it has to be a really good business reason for us to include the working capital within the loan. Like we would need to see the seller's financials to see, what kind of cash they've always had in the bank. And if the seller's not leaving anything within the company, which is very common on an asset purchase.
Right.
And if our buyer doesn't have enough cash to put in that bank account, we're going to start asking questions how they're going to run the business day to day once they take over.
And on your lines of credit, what are you usually using as a benchmark or security for those lines?
We're looking at the company's accounts receivable, accounts payable primarily. On occasion, their inventory, if that's how they're using their line of credit, but predominantly those aging reports.
Yeah. Okay. So kind of over a historic average. 12 months,
Right.
something like that. Okay. So you've already talked a little bit about buyer experience when they're in the industry that they're actually purchasing in. And this used to be 3 or 4 years ago, not that big a deal as long as they had what are known in the business as transferable skill sets. But over the last 18 months, I think almost all lenders have really leaned into experience in that industry as being really important to be able to purchase a business.
Yeah, it has. I don't know if it's just the trends that are happening currently or what they're seeing and knocking on wood loans that go wrong, that they really want to see some good transferable experience. I mean, one thing that helps is I had a buyer once that trained underneath the seller for a few months, and then we started doing the transaction. So that way they were already trained up. I know that's not always an ideal situation for everyone, but that was a really good way to get that individual into the door. So that's one option.
Yeah, I've seen, we did a transaction not too long ago where we had a employee buy the business from his boss. They didn't really have any cash to put down, and so the seller in this instance allowed or gave him a 10% note, but he deferred all payments until the SBA loan was totally paid off, and then he got his payments. Is that something that you guys, because sometimes you get SBA rules and then the lenders overlay their credit criteria and may not match up. I don't know if that's something Wells entertains or takes a look at from time to time.
Not at this time. I mean, we'd prefer if they had shares in the company. So
Right.
I have a few that have done that where they become business partners, but minority.
Right.
And then we buy the rest of the shares. That's usually how we try to spin it.
Okay. And seasoning on that ownership?
At least, well, SBA requires at least 6 months.
Okay.
Preferably a year where we've got it on a tax return.
Okay. So that's the better way to do it. A little cleaner.
Right.
Okay. Well, Jessica, I don't really have that many more questions for you at this time, but I do want to let our audience know that if they will leave questions for either myself or Jessica down below in the comment section, either one of us will definitely get back to you with answers. So, well, we'll expect Jessica back this fall for an SBA update. So, Jessica, thank you. And again, please leave your questions below, and I will leave a link directly to Jessica in the section below. So, again, Jessica, thank you. Great conversation with Jessica Beck of Wells Fargo, and I want to thank her for taking time out of her busy day to join us to discuss the 7A program and the business acquisition portion of that product offering. Like I've indicated before, if you've got specific questions for either Jessica or myself, please leave them in the comment section below, and either one of us will get back to you with an answer. So if you got something out of this episode, please consider hitting the like and subscribe button down below, and we'll see you in the next video.